Now for a look at some of the top moving stocks in today's market, I'm joined by Jenny Horne, markets correspondent here on Schwab Network. You're watching Workday hitting new 52-week highs today after its quarterly report. Tell us more about that.
Yeah, some really strong third quarter results out of Workday, Nicole, but also really strong commentary from management here as they did report third quarter earnings and revenue that both topped analyst estimates. Also raising its 2024 revenue outlook now, which then continued to see analysts come in, update their coverage to the upside. One analyst we saw was Jefferies' Brett Till, who said management also initiated this fiscal 2025 subscription revenue guide at 17% to 18%, which was in line with street expectations, combined with some really solid margin expansion in the period. Revenue climbed, like he said, 17% to $1.87 billion. We did see earnings come in around $1.41 per share. That was basically better than what we saw a year ago, pretty substantially. And the company did say following their momentum in this third quarter, they're raising their 2024 subscription revenue guide to around $6.56 billion, representing around 19% year-over-year growth. They're also raising their 2024 non-GAAP operating margin guide to around 23.8%. Their focus is very much centered on investing to drive this long-term durable growth while expanding their margins. So as a result, a nice pop in Workday shares, fueling the fact that it has been one of the stocks that's seen a nice November rally, as we're up over 20% now month to date.
Okay, thank you for that. And we're seeing a lot of price target hikes. I see a lot of buys, some neutrals, but a lot of good commentary from the analysts there. And then there's Foot Locker, another stock to the ups after its earnings reports. Your thoughts there?
Yeah, a name that made a nice 17. I mean, we're up almost 17% here in real time. A nice move that's held at least through right now's trading on the session, because Foot Locker needed this love. This name was one of the most disappointing post-earnings moves we saw last quarter. It was down over 20% after its second quarter release. So nice to see shares surging today, as they did report still a sales decline of around 8.5% year over year to just shy of $2 billion. That did beat expectations on adjusted earnings of 30 cents per share that also exceeded forecasts. Comparable store sales decreased by 8% versus last year, driven by what they said was ongoing consumer softness, changing vendor mix, and a 3% negative impact from repositioning their Champs sports brands. Gross margin did contract by about 470 bips, driven by, again, higher markdowns as well as occupancy deleverage and higher shrink. But still, the company did hold around $187 million worth of cash through the end of October of this year, and highlighted merchandise inventories had increased about 10.5% year over year. So they did open around they operate around now 2,600 stores, opened around 22 new stores, and remodeled around 36 stores while closing 14. So I think it seems like this company is getting itself into a better cash position, still reeling though from the effects of that deteriorating Nike relationship, which is still something fundamentally that I think investors need to keep on their radar near term. This report wasn't like a clear all. They still have the same headwinds in place, just perhaps it was better than feared given the positioning into this report.
Understood. Jenny Horne, thank you, markets correspondent. Appreciate it.